recording.
Okay, this is a meeting of the Maurice's Finance Group of the Maurice's Campground Purchase Task Force. And it is approximately 11:15 on Friday, the 29th.
Okay.
Okay.
You want my email address? It's
Yep.
EJP as in Peter A at AOL.
There it is. All right.
So Harry, now that I'm the host, I have to give Ryan the.
Yeah, you can make me the co-host and I can do that for you if you like.
To make Ryan be able to share, or do you want to be just the host, Ryan?
Sure.
So,
I co-host most of our meetings for the
Okay.
select board, so.
so to make you the co-host, how do I do that?
Go to participants,
Yep.
pick Ryan and right click on him and there'll be a drop down menu, one of which will be either make host or co-host. If you make him the host, you are no longer the host. If you make him the co-host, you both have the ability to do stuff.
I see Ryan. It says more.
Yeah, click on
Make
that.
host. Okay, so Ryan, I'm going to make you the host.
Yep.
Okay.
All right. Good. Sent. All right. I just sent it to you, Emily. Probably take a minute. So yeah, Campground finance plan. Did you get the spreadsheet I sent as well?
Yes, Ryan.
Okay. Okay. It's over here, that over there.
Is
Okay.
this the updated one, Ryan?
Yeah, there's not a whole lot of changes. I just updated a couple of figures after I did more of the math. So, and caught a couple of mistakes, but overall it's largely the same. So interest rates, as it says, every 0.5% adds about $50,000 to the life of the loan. The bond structure we looked at earlier when we were first looking at everything. And, you know, it significantly raised the cost if it was level funded every year as opposed to the standard municipal structure. So, you know, we had decided then that it would, you know, it would be the standard structure. The borrowing term, we really haven't discussed. There is a difference in the total cost of the loan over the life of, you know, a little bit over $1 million. If we
Ryan,
go, yep,
can I interrupt you there?
yeah,
Under the cost of the loan, the 11 million and the 10 million that you have on the boxes on at the bottom there.
Yep.
I didn't see that matched what you had on the spreadsheet.
so that's incurred for the life of the loan. And it's actually, this one is, yeah, that's the life of the loan. So that's how much it costs, you know, for the principal plus the interest.
So in the spreadsheet, it shows that the differential is about 1.5 million between 20 and 30 years.
It depends on the interest rate.
Obviously, right, but
So,
on the one that you showed, I think it's for 4.5. Well, I'm saying is, I guess just double check those numbers that you have in
Yeah.
those boxes
so it's
and see if they true up to what you have in the spreadsheet.
fine.
But before
Yeah.
we go on that, is the town actively looking at or considering a 20-year loan versus a
No, I
30-year
mean,
bond?
we're the financing group. So the you know, we can make a recommendation of one or the other. Sorry, so I'll update that in a bit.
But you have to do it on the fly, I'm just saying.
Yeah. So I don't know. I mean, the downside of a shorter loan is a higher payment, yearly for homeowners, or taxpayers. I don't know.
Is there any way we can get a handle on an idea of what it would cost, the 20-year loan?
Yep,
Applying all the other things you're talking about for the.
Yeah, it's included on the spreadsheet.
Oh,
So
okay.
that's
All
a
right.
20-year loan. If we were to finance the entirety of the purchase, because that's just an easy number. It'd be for a 20-year loan at 4.5% interest. The total cost would be $9,571,250. And for a 30-year would be $11,033,750.
Right, that's where I came up with the
Yeah.
difference. Ryan, I
Yep.
agree with Elaine. I think if we had just two boxes almost side by side that showed here's the 20 and 30-year cost, and here's the impact on the tax rate. And the question would be, is that something you would want the voters to decide or the town to decide?
I think the town has to decide what they're gonna ask the voters. For. Harry?
If I may, typically what you get from the voters is to authorize the treasurer with the approval of the select board to borrow. The actual setting of the terms is up to the treasurer with the advice of the select board.
Given the differential, I mean, unless there was some hue and cry, it seems like we ought to go for the 20-year bond.
Okay.
What do others think, I guess, is the question.
And there is a, at the end of the memo, there is another spreadsheet that kind of, this one, I've updated the numbers here, and this breaks out the
Mhm.
cost for the taxpayers
Oh,
after
okay.
everything. So,
Ryan?
Yep.
In your spreadsheet, when you show the differential between the resident and non-resident, I think there's an error there because the non-resident would have to go up when you take into consideration the 25% exemption.
yeah, I haven't factored that in.
Okay.
So, it's just the average yearly cost for a median home, and then the cost with the residential exemption.
Right, but obviously the voters are the residents.
Yep.
I mean, if the question is, what does it mean to me?
Yeah.
Now, how much will it cost me? That's probably what they want to know.
Yep.
Right.
So.
But just
I'll double check.
double check that number. It didn't
Yeah.
seem to foot to me.
227. Let's see. Yeah, I was doing math this morning, double checking everything, so.
You've done a
I'll
lot of
double check.
work, Ryan, so.
Ryan, you've done a tremendous amount. Thank you so
Yes.
much for this.
Yeah.
This was terrific, actually.
Okay, so recommendation, consider,
Well, Ryan, can I,
Yeah.
if we're not paying the same amount every year, you said the average costs, like, do we know how much higher the first several years would be?
yes, so, and, oops, that's the wrong one. Let's have this.
Um,
Have this,
you know, If I may, I'd suggest just presenting the taxpayers with the estimated schedule for 30 years and just leave that whole issue off the table. It makes things more complex and probably doesn't help the voters to understand what we're asking of them.
But Harry, if you do that, and then you issue the bond for 20 years,
Yep.
have you created some confusion or misinformation?
You possibly have, but typically, for example, when we did the borrowing for Nauset High School, that borrowing was done by the regional school committee, and the town voted to approve the borrowing. But there was no discussion whatsoever about the interest rate, the term, and the way the term was settled was, a meeting of all of the budget directors of the respective towns. So it was just completely off the radar.
Hmm.
So even though there was an example there, it really didn't figure into the debate. I don't know, it just seems to me that we have a complex problem to present them, and we should try and not make it more complex if we can avoid it. We can, we've been very clear that this is an example of a debt schedule. But, until we actually go out to bond it, we don't know what it'll be.
But it'd be good to include a recommendation. It doesn't necessarily have to be to town meeting,
Mhm.
but as part of this process. So this is the 30-year loan, after factoring in everything at 4.5%. I can try to make it small, bigger. Where's few? So at the beginning, the rates are the highest, but we'll have the enterprise fund operating for the first 6 years. So it kind of offsets some of the costs. And then this is what it would be per year, assuming 4.5%, in just ballpark.
And that's the 30-year?
Yes, this is the 30.
Yeah, that,
And then
So, wait.
that's
can I-
before the residential exemption.
Is this the column called house? Oh. Is
Yep.
that the
Yeah,
bottom line?
impact median house.
Oh, I see.
So the average for that 30-year then is,
7155. And for a residential exempt or a house with a residential exemption, it will be 5615.
so I think Harry is right, is that at the end of the day, people want to know that it's going to cost me about $50 a year to fund the debt for Maurice's.
And then this
Could
is
the-
the 20.
could somebody let Olga in?
Sorry,
Ryan is the host now.
I think she might be waiting.
we have a Jamie Bradley.
No.
I don't see Olga.
Because she just texted to ask if she was too late, and I said I would ask them to let her in, so maybe keep an eye out.
Okay.
I don't-
And this is the 20 here. And this is what it would be. Yearly. And then this is what the median would be. And this is what it would be with residential exemption.
So the difference, Ryan, between the 20 and 30 on the voters would be about $50 versus $100 a year?
No, between 56
and
to
70.
75. So
56 and 75. So it's not a lot of money.
it's about $20.
Right, and it saves the town a lot of money. But anyway, you will decide, the collective wisdom, financial wisdom of the town will decide that.
Yeah. I guess.
Were you hoping we would make a recommendation, Ryan?
I just brought it up for
Mhm.
sake of discussion and, yeah,
I think the difference to the taxpayer is so small
Yeah,
that not having to get into too much detail, as Harry said, is not a bad idea.
right. It wouldn't show this big spreadsheet.
So, all right.
Can I just ask, since I'm looking at this for the
Sure.
first time? So this is taking into account all the other sources that
Yes.
you're bringing in, and are those numbers, you're reasonably confident in them?
Mhm.
Including the,
Yes.
and what the is the funds actually coming from the campground itself? Where is that?
The enterprise fund, so, sorry, let's go back to the memo. It's in here, but the, so community president, yeah, enterprise fund. So, yeah, it is just for 6 years. We've committed to running the campground. The current owners have said that, we should be able to accrue, $200,000 if we hire an operator. And then so I backed that out to 100, or, a little bit under 100,000 to be conservative.
Mhm.
So, yeah. So for the life of the enterprise fund, it would contribute around 96,000 per year. That could definitely increase, but I think it's better to go conservative than, you know,
So is that number, is that sort of like the net profit of the operations, or what is that?
so it's, yeah, basically a net profit. But there will probably be more than that, but maybe not, depending on what else is happening each year. It varies. So, yeah.
No, I'm only asking because I know it seemed like there was a lot of uncertainty about the actual numbers. And what it would, and I just, why I asked why if this has been verified recently based on what you have learned about the operations.
Yeah, I mean, so we met with the Gauthiers recently, last week, or was it this week? I don't know, I'm losing track of time. And went over some of the numbers and assumptions. And they said that their salary entire equivalent would be around 125 to 140. And that would leave the campground. Right now, it currently produces around $400,000 net to them. So if you take into account their salary, it nets out at about 300, and then there's some maintenance that the town would need to do, for the campground, and average, I forget what it averages out to per year, but the first year is the highest, and then it's less after that. So it's, I think, about 100,000 a year, so 200,000, give or take. Yeah,
Brian,
I don't have that spreadsheet with me right now, so.
Brian, I had two comment and a question. You're averaging only about $85,000 a year in net income for the enterprise fund, but I understand you're being conservative, so it may be more than that, and well, that would potentially impact the tax debt that the individual homeowner has to pay. If there's
Yeah,
more here, there's
I mean,
less. We'd have
if
to borrow each year.
Yeah, if it generates more than that, obviously we'd be applying it towards the purchase of the property.
That's fine. So,
Yeah.
right. So that there is some upside to that, I guess is all I'm saying is. But the second is, I didn't understand the machination with the beach fund. Is that because the enterprise fund won't be created until next year?
No, so we need to fund the enterprise fund.
Right.
There are expenses, upgrading
Yeah.
some of the, particularly with electrical systems, getting them up to code.
Right. No, I understand that, Ryan. My question is the 142,000, couldn't that come directly from the ARPA payment into the enterprise fund? Or
No,
does it have to go into the beach fund and then be transferred back?
it would have to go to the beach fund and then be transferred. Or the other option is to use it to apply for other qualifying uses that might be funded by free cash and then transfer the free cash into the enterprise fund. This part is still kind of up in the air of whether or not we can do it like this, but it's a possibility. I know they were looking into it. Because of how tight they're going to be on meeting the deadline for free cash, they don't want to try to use free cash to add an initial fund. So
Is your
Yeah.
hope still to certify free cash at the September 10th meeting?
yes. But there's a possibility that might not be ready.
And we don't know what's going to happen to the campground after 6 years. We don't know
Right.
what's going to happen to it now, but certainly if it doesn't stop abruptly, we'd still have income that would help to defer that expense.
Yeah, I think if we go beyond 6 years, we'll have to incur additional expenses to continue to operate the campground at that time. So we'll see.
Okay. Could
So
you,
that,
I'm sorry.
oh, sorry, the ARPA payment that you're talking about there is the direct payment to the town?
Yep.
And of which I saw on the county website, the amount listed, maybe this is just the first one, is about 200,000.
No,
So-
that's the county's,
of the county's allocation.
yes,
So in addition to that, you have direct money.
yep. All municipalities receive direct payments from ARPA. For Cape Cod, there's also Barnstable County, which received, like 41 million. And they've released 10 million. There are restrictions on ARPA as to what you can use it for.
Yeah.
And if you don't use it on allowed use, then you have to basically pay the treasury back whatever you used. So,
Ryan,
yep,
Elaine sent out a note from Laura about some changes in the use of the ARPA funds and eligibility. I'm wondering if anything with respect to Maurice's now qualifies.
no, it would be really hard because it would be subject to the 80% AMI. And I don't know, it's just maybe you could have an additional piece of the parcel, deed restricted. By that point, you're talking about maybe half an acre to 3/4 of an acre, and it's just not possible, really.
So wait a second, I don't want to sidetrack to that topic, but since it was raised, I mean, she was also telling me, I'm not sure, Elaine, was this a conversation you had with her subsequent to the memo I sent out to you guys? Because she was encouraging me, yeah, to have you look at it as well. And I guess the question is, if the only issue is the ARPA, I'm sorry, if the only issue is the income restriction, is that the only issue, or are there other ones? Because I thought there was some confusion also about whether CPA would allow you to go to 100%.
I think what you may be referring to, Ryan, is, and I raised this with Rich Waldo to ask town council, while CPA allows us to go to 100% of AMI, the deed restriction, the deed rider,
Yep.
which is DHCDs, I think has an upper limit of 80%. So that may come into play. If we in fact have to use that deed rider, and then it's 80%, and then the question is whether it's worth it to apply to the county.
I mean, for the amount of money that's available through the county for it, I would say no. The, it would make sense to use that for something like 95 Lawrence Road or something along those lines, and not this purchase.
Okay.
But I thought the amount available was like $30 million.
No, they can't. They're fighting over it. They've only agreed to figuring out a way to disperse 10 million, and they'll probably be fighting about it for at least another year at this point. There's a conflict between the commissioners and the assembly of delegates. And it's based on population, what they released so far. So it's not competitive. It's based on, each town would get, a certain amount of money of the county's ARPA payments.
But wait a second, I thought there was 42 million, and that 10 million has been released by population. But the rest of it, according to Laura, and when I looked on the website, is available for competitive applications, which they've started to receive. And when you go on their website,
No, the applications that are open right now are only for the amounts that were approved for each town. They are not, they can't reach an agreement as to how to disperse the remaining money.
you mean the 10 million, of which Wellfleet is only qualifies for like 200,000?
That's the only money that they've reached an agreement on how to disperse.
But that money has to be applied for by project specific use to them?
Yes.
Yeah. Ryan, I did listen in on the advisory committee meeting, and it looks like they're really moving towards recommending to the commissioners and the assembly that housing and water are the priorities. And then Laura said that just recently the federal government relaxed in some of the issues around affordable housing. I haven't digested what that said yet, but I still don't think purchasing is much of an option. I think, I'm hoping that POA CDP are really looking at it, or I don't know if the town can also.
It would have to, so from the county right now, it would have to be an application made by the town. So, it would make sense for 95 Lawrence Road for purchasing a property. No, it doesn't. So.
Right.
So can I, without having seen it, I'm guessing that what Laura sent around was something that's not relevant to this project, because the big news this week was they relaxed the restrictions that this relates to how a developer can use the funding in a tax credit project. There had been this issue that all the funds had to be expended really soon, and nobody could figure out how you could get a long-term loan using our funds. So all the affordable housing developers are very excited about this because it enables us, through the DHCD competitive rounds, to use the ARPA funds in conjunction with tax credit.
So rather than, I'm gonna interrupt Emily, rather than go round and round on this. So Elaine, you have the close relationship with Laura, or is it worth a phone call to her just to say, is there any possibility of getting money for 95 Lawrence from the county? If it's no. If it's
No,
yes,
for that's definitely a possibility.
that's definitely a possibility.
Yes.
I'm sorry, I misspoke. For 95 Lawrence, I understand. For Maurice's, is it a dead issue, you think, Brian?
It's not even worth investigating. I
Okay.
checked earlier, or when we were first looking at, how to purchase this property, and it's not
Okay.
a use that would qualify
All right, then
I'll,
let's.
I'll
let's-
I'll just say that she, I mean, you might want to call
Emily,
Laura.
Emily, can I
Yeah.
interrupt? I think we're going to move on from here, but thank you.
Okay.
Okay, Ryan, I've been involved with housing for a while, and I really had a hard time understanding the mixed income housing stabilization fund.
Yep.
Is there a way to explain that to the average voter?
What do you mean?
Where is money coming from?
The two community impact fees on short-term rentals that were approved at the annual town meeting.
And-
They're the single-family homes where an owner rents more than one,
Right,
or a primary residence that includes a seasonal rental.
so if your estimate is, for the sake of being conservative, that it'll raise $40,000 or $45,000 a year from this fund? You said the range was 35 to 55, so it would be $40,000 a year, 40 or 45. And wouldn't it be over the 20 or 30-year term of the bond?
Yes, but so yeah, I estimated it at between basically 43 to 54. I
Okay.
think we should estimate lower than that.
All right,
And then we'll only have 2 quarters worth of revenue when we go to the annual town meeting. So they were effective as of October 1st. So we'll have, October through January, February, May, through the end of May. So 2 quarters of receipts.
So all I'm asking, Ryan, is in the table that you show at the bottom of your memo.
Yep.
In the source of income, are we being too conservative in that if we're talking about a 20 or 30-year term?
I mean, we could be, but I would much rather be conservative because it's there's a lot of variance in this revenue source. Particularly, we don't have any actual receipts to base we don't have actuals. So yeah, there's a lot of math I did, but I wouldn't be comfortable budgeting more. And you'd have to be careful about, so short-term rentals do have some variability to them year to year, and so you never want to appropriate probably more than 80%.
How much did you, I can't scroll down, but in the table at the bottom,
I budgeted it for 400,000. Well, to assume
400,000.
basically the debt of $400,000.
yeah,
Overall, it pays in, where is it? Short mixed income. I'll put this one back up. All right, so this is the mixed income here, the purple. So overall, it pays in almost 600,000.
okay.
I
So
mean, we could have receipts that exceed that, and we could approve more than that. It's just, it's fairly speculative right now about how much it will actually come. And I'm very hesitant about going before the voters and, with a financing package and then having it come up, short.
Right. It doesn't mean if we get more, we can't apply more. I think being
Right.
conservative is very important.
Harry, I know you have to go. I don't know if there's anything you want to highlight or ask before you leave.
Harry, you're muted.
I haven't had anything to say for a long time. I think that the main message in terms of, well, I guess there are two things. One is what is the plan, and number two is what is the message. I think that the message has to be that, yeah, this is sort of a worst case. We borrow $6.5 million and we finance it this way. And the second part of the message is, here's what we're planning to do to mitigate it. We're going to apply some portion of Community Preservation Act revenues towards debt service. We're going to apply hopefully some portion of short-term rental community impact fees to debt service. We're going to apply some portion of campground operations to debt service, but we can't guarantee specifically what those numbers will be at this time. It's just, that's the plan. We're confident that those numbers will be significant, but we can't tell you what they are. So that's kind of the message. The plan, I think, is that message kind of more formally stated, and just making sure that each of those pieces is available. And that's kind of the way I'd summarize it. I'd get away from, well, is the interest rate going to be 4 or 4.5 or 5%? Is the term going to be 20 years or 25 or 30 years? I'm not aware of any town that's ever done level payment debt service. Typically, you always do level principal payments and declining interest payment balance, declining interest payments on the balance. And that's what makes the payments decline over time. Homeowners always do the opposite. They always do level payments of principal and interest. But I've never seen a town, I'm not aware that a town's ever done that. So again, I wouldn't bother to put that on the table unless there was a later revelation that said, oh, this is the way to do it because right now it's going against the weight of experience. So that's kind of how I'd summarize what I see. I haven't checked the figures. I did look at them briefly, but I haven't checked them. I do have a spreadsheet I did earlier with a 4.5% 30-year, $6.5 million bond. And I guess that kind of summarizes everything I got to say.
Thank you, Harry.
Okay.
All right, so I think the question is, where do we go from here, Ryan? And
So we have to, basically present a financing plan to the select board. And Sharon's been pretty clear as well that it is a concern of the voters as to, how are we going to pay for it? Basically, majority of the purchase will be from the tax levy, but we're mitigate probably between 30 to 40% of the borrowing costs through these other funding sources. Yeah, I don't know if that,
I think that's a good, accurate summary. I think you did a great job on this memo, and maybe clean up the changes we've discussed today and the ones we've already made. And should we release it to the whole committee then for comment? That this is our plan of how we're going to approach it to the taxpayers.
I mean, we can.
What do people think?
I mean, I think the work you put in, Ryan, is amazing, and it is definitely a plan, and I think it's a really good one. I think Harry's telling us to simplify what we're putting out there a little bit so that it's, it's pretty evident that we're going to borrow 6.5. We're going to use these other sources to help fund it, and this is approximately what the taxpayer will be spending. I just think simplifying the message. I mean, I think it's the plan we have. I don't think we need to decide between a 30 and a 20-year bond ourselves. But I think all the work you put into it, it makes a lot of sense, and it's very, it looks really very doable.
I don't know if I can simplify the explanation of the mixed income.
I mean,
Or-
can't we just state we're using these sources? We would, the plan is to use these sources, which will reduce the debt by approximately this amount. I don't know that we have to explain what it is again to people. I mean, the select board, sure, great, but I don't know.
Are we in agreement that we're not going to use any money from the Affordable Housing Stabilization Fund?
So the receipts from that are going to be smaller than the affordable, than the mixed income. And it would be better, it's just would create a whole lot of additional work for minimal
Yeah.
gain.
All I'm saying, Ryan, is we could take that part out.
So, yeah, I mean, basically it says that, we'll look to replenish any funds expended by the Affordable Housing Trust for the due diligence with monies from the Affordable Housing Stabilization Fund. I don't know. I mean, we can drop it. I do think it would be good to do that, though.
I'm not disagreeing with the strategy. I'm just following up on what Elaine and Harry were saying about trying to simplify it.
Yeah, I don't know. I'd like to leave it because otherwise it just, it has to be like on the table for it to happen.
Can we go
Okay.
back up? Shall we work through it just briefly again now that we've
Yep.
kind of looked at the whole thing?
All right, so interest rates, bond structure. I guess we can drop the bond structure. I do think the explaining that that payments are, will decline is important.
Sure.
Can we go back to what it is we're producing this for? So it's not for the task force, but for the select board meeting. Is that correct, Ryan?
So it would be for the meeting on the 9th for the select board.
The select board. Isn't that isn't that the audience that we're addressing?
We're also addressing the taxpayers as well.
Yeah.
And what their concerns are about,
Right.
how are we going to pay for it?
So if we took out the structure and the bond term, we understand that those are real issues, but it's really not something that the taxpayers are going to deal with.
I think the structure stay, I think possibly the borrowing term could come out,
Okay.
but I think the bond structure part is, good information.
Okay.
And you don't have to say the level payment, maybe, that's a thing that
Yeah,
always doesn't happen.
I mean, we did look at it.
Mhm.
So,
Okay, yeah, so you're just saying, you're showing that that was all looked at then, right?
Yeah.
Okay,
yeah, I
Well,
don't know.
actually, if we take out bond term, then it makes those columns somewhat.
Yeah, I don't know. I mean, the real table is the
Okay.
one down at the bottom.
yeah,
um,
right.
Right.
Yeah.
Which is this one. So this is I mean, 30 and 25. I mean, we can leave that, I guess. I don't know. I mean, like, I just think of what I would be looking at as a member of the select board. I'd be looking at, what's the cost to the town? How does a 20-year loan compare to 30? I don't know.
Yeah, no, I mean, you've done all the work, so, yeah, showing it. But
The-
maybe we don't make a recommendation, maybe though, that would be up to when the time and the place comes,
Yeah,
town to make a recommendation.
yeah, and we'd probably want the town administrator and the finance team to weigh in as well on it. The Community Preservation Act funds. Sorry, I just got an email. So Lisa Suve. So this came in 44 minutes ago. There's 144,000 in undesignated fund and 41 reserved for housing. So conceivably, you'd have 185,000 essentially that could be paid for in cash, and the remainder would be borrowing, which is not ideal, but yeah, I mean, that's a question for the Community Preservation Act or Community Preservation Committee, how they want to do it.
So according to Lisa, there's only, these numbers would be additive, I assume?
What did you say, Gary?
I'm a little I'm seeing this for the first time, but is the total of the funds available, irrespective of open space and housing historic, is the total of these columns? Is that correct, Ryan? There's 144 of undesignated plus the
Yep.
149, 41, 270, and fund balance budget reserve. I'm not exactly sure what that is, but
Yeah, that's the extra money that's not committed for the 10% or any projects right now, I guess.
so what's the undesignated fund balance then? Elaine, what's the difference between those two?
It's
Well,
all the money, it's, I'm not sure. I would say it's
think-
the money that is still there that hasn't been applied to any project.
As opposed to the fund, but anyway, it doesn't matter. So the addition of all these numbers is the total CPA, but in terms of additional money that we could apply to Maurice's, it's relatively small, or we could apply some of that 144 and that 76 plus the 41.
Is that just that doesn't include the state share?
Well, that's a question I have as well.
Yeah, I don't know, so I'm not sure.
We had, Ryan, just for this year, in excess of $200,000 in the extra money we got from the state
Yeah.
in their match. Okay, so I think what this says, unless we find out differently, there isn't a lot of other money that we can apply to Maurice's from the CPA coffers.
Well, yeah, there isn't a whole lot of cash on hand to apply towards it. So the sum itself will probably, will have to be funded by, the borrowing. So,
Okay.
all right.
Right.
So enterprise fund, revolving fund. So the town administrator isn't really sure if it should be an enterprise fund or a revolving fund. Yeah, he's been trying to talk to the Department of Revenue. So I'm not really sure what the difference would be. I kind of lean towards enterprise fund, but yeah.
All right, are there other questions that folks have? If not, then Ryan, the basis of this, we can use to send to the task force as a whole to the Friday general meeting?
We don't have a meeting this Friday.
No, next Friday.
Yeah, we have a meeting next Friday. Yep.
But the real purpose of this is to present the financing of it to the select board on the 9th, and then to the voters, a month hence.
Well, probably before that, with the community outreach.
Right.
So
So do we need to produce anything like some slides or something that would be, you are presenting, is that correct, Ryan?
I think so. I
On
think,
the
yeah.
night, yeah, right. So can we produce some slides or do something to help you with that?
I don't think there needs to be very many slides. I think,
Okay,
yeah.
all right, so no, and nothing else that you need from us.
I don't think so.
And Ryan, will the other Excel sheet be part of this being submitted?
Yes. Just so that people are aware. Because, the part about, what the payments are, also is important, by year. So,
Right. Well,
Okay.
I think you did a
so,
great job.
Ryan, you did a great job. I mean, this was a really complex issue and you did a good job of encapsulating it in this memo. So thank you for that.
yeah. And the mixed income housing stabilization fund, it could be, double of what I'm saying here, but it's just too speculative that I'd much rather have a higher number than expected than a lower
Mhm.
number than expected.
Yep.
Okay, so Ryan, you're gonna make whatever changes and corrections you're gonna make to this memo and then send it to the group as a whole. And is there anything else that we need to do either for next week or for the select board meeting on the 9th?
I mean,
Nope.
I'm not sure. It depends on, yeah. The one thing that we do need to look at is the deed restriction.
Yeah.
That's the last remaining piece, besides the due diligence, and I guess the appraiser is going to be towards the end of August as well.
Towards the end of August, so we won't know the actual amount.
Till the end of August.
Okay.
So I think he said the August 25th.
But
yeah.
But it's like the other sources of income that you're talking about here. It doesn't actually affect the bond. It only affects how much the individual taxpayers will bear in any given year.
Yeah. So,
Ryan, in terms of the deed restriction, I mean, we have the deed restriction that DHCD uses for homes and rent, property. Do we know if they think it's applicable to this, or do we really need to do? I mean, I don't know if Orleans, when their trust paid a couple of million for the Cape Cod 5, they must have some sort of deed restriction. Should we look into that?
Elaine,
Yeah.
we asked that specifically of Stuart and of Jeff, and they
Mm-hmm.
said it was the same deed writer.
Okay.
I can ask that again if you want. And
Yeah.
the other question is does it max at 80%?
Yeah, that's where there could be some adjustment, because even at Gull Pond, where 2 of the units are market rate, they all counted on the subsidized housing index because of the fact of something else. It's so complicated, but yeah, we don't want to make sure we don't restrict ourselves in a way we don't have to.
We can certainly ask Orleans what their deed writer was.
Yeah.
yeah,
Right.
and then, we probably need to send it to town council as well.
I said that to Rich Waldo is that we're hoping to get the wording of the warrant article motion.
Yep.
Which I'm sure will be different than this CPA motion. And that in there, the question of 80% versus 100% on the deed rider was raised.
Okay. So I know that's an article that's still getting worked on.
Right.
All right.
Oh,
Can I
go ahead.
have a question about the 80%? Is there a Wellfleet AMI or is it Barnstable County?
The county.
Barnstable County.
Okay.
Yeah.
And do you think someone will want to know what that number is? What the AMI is? Because I think on the street, people want to know, can I, live there? And I think the AMI is quite high,
Yes.
so it might be worth indicating that. And because it's so high, I'm not sure why we're avoiding 80% funds that are limited to 80% AMI.
We're not. It's just, so the ARPA funds are limited to 80%. And there's a whole host of other restrictions associated with them and practical to use them to finance the purchase of a property. It was one of the first things I asked was, all right, I know it's not a whole lot, but can we apply it? And it was no. But yeah, so the first payment was transferred to, the first direct payment to the town was transferred to the Wellfleet Affordable Housing Trust. And then the second payment, we could do that with, or it's possible that we might be able to do what I'm suggesting, which is use it for part of the seed money by replacing revenue that was lost from the beach fund. And then the other one would be ideal. I mean, the county would be ideal for 95 Lawrence Road or potentially Payne Hollow.
Right.
And hopefully they can decide how to disperse the remaining money that they have before the authorization to, with enough time for towns to actually expend it. Because it has to be expended by a certain date as well.
Yeah, it has to be allocated by December of 2024, and then it has to be spent by December 2026.
Yeah.
But Ryan, how do we coordinate the town applying for like 95 Lawrence? Who do we talk to? Who starts this?
I was thinking about doing that after Gary forwarded me the thing with Jay.
Mhm.
And just try, because I'd like to try to avoid talking about it in an open meeting
Okay,
right now. But yeah, there are different things that we might be able to do to get a little closer to that number and reduce the impact on CPA funds.
right, good.
So we'll see.
All right, let us know if you have any tasks you want us to do.
Yeah, I'll probably, when the warrant's closed, I'll probably try to pull something together. So,
Okay, great.
yeah. All right, anything else for today? If not,
Thank you again, Ryan. This was a Herculean task in a short period of time, so much appreciated. And thank everybody else. Time on a July Friday.
all right, well, have
All
a
right,
great
I'm gonna
day.
stop.
you.
Ryan, I think you have to stop the recording now.
All right, yeah. Yes.